Okay, okay. All right. I'm excited today because we've got something a little bit creative, a little bit unique today. And it's actually raining here in Florida. So for everybody that is up north that's going to be watching this, you can feel a little bit better because it's not 80 degrees and sunshiny. But my guest today will actually know a little bit more about that because he's actually in the Tampa area. Jeff Steckman from Asset Exchange Company. He's the Eastern Regional Manager. And for years, Jeff has been handling, and I don't even remember how we met, Jeff, but I know that you've been handling many of my agents, clients, or many of our clients here at Realty Executives, their 1031 tax exchange situations. And it's something that's not really, it's not as well known as it should be, I don't think. I think investors have a good hold on it. I know a lot of times our realtors, and you had a real estate session yesterday on this to kind of educate the realtor community as well. Uh, uh, Many times I find that they're really not as well informed as they should be. And that's why we do these things. But also, I really want the public, and really what this channel is about is, the general public and being interested in buying and selling in the Villages, Florida. And I know a lot of people have been interested in moving in our direction for tax reasons, for political reasons, for COVID reasons, weather reasons, all kinds of reasons. And I think people need to know more about what 1031 tax exchange is. So without further ado, Jeff, welcome.
Thanks, Glenn. I had it on mute. I didn't want to interrupt you. Yeah, and as Glenn mentioned, gosh, I've been working with his agents for probably a few years at least, probably
Yes.
5 or 6 years, something like that. And
Yeah.
I've actually done some classes up in the villages for his agents. I think I've done two now that I kind of remember.
Okay.
But yeah, I've actually been in the business for 26 years. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But I actually live in Tampa, Florida, and I've lived in Florida for 23 out of those 26 years. And as long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And gosh, hopefully we never have to see those bad times again. I mean, the industry right now, it's just booming, and boy, hopefully we can carry this into 2022.
Jeff,
But
can you
yeah,
speak to that? I mean, what kind of difference are you seeing now versus like 1031 tax exchange transactions this year versus like let's say 2009?
oh yeah, it's probably up 50%. I mean, it's like it's incredible. This is probably this is probably the best year I've ever had. Because one of the reasons is because you know, everything's appreciating. So now when somebody sells, there's even more of a reason for them to do a 1031 because they're looking at higher taxes. You're paying taxes on the gains and depreciation capture. We're going to talk about that in the next few minutes, but yeah, so I think that's one of the reasons. And the economy's do really good. I mean, you probably see it on your end too, Glenn, with your folks. I mean, how I would imagine y'all are probably busier than ever too, right?
Yeah, we saw a record number of transactions pretty much from January all the way through June. I think the rest of the country saw the same thing, but the villages saw a record number of transactions. And now what's interesting is that it's kind of tapered off a bit, but I think it's more of a normal demand right now for the last several months here in the villages.
Right, right. It might be that just that time of the year too. Things typically slow down a bit in the colder months. Not that it ever really gets that cold here in Florida,
Mhm.
um, but the springtime, at March, April, things start to really pick up. Um, and and also, I mean, right now it's the holidays. It's Thanksgiving, Christmas, New Year's. You know, People probably don't want to show their homes maybe right now. They don't want to be dealing with any of that
Mhm.
while their house is decorated or they're having parties and that type of thing, or family in town. So that's probably another reason as well.
That's right.
Yeah. Um, well, yeah, let me just, I guess we'll go ahead and dive in about 1031. And Glenn, thanks for bringing me in today. Um, I'll give you a little bit of background about the about the company. If I can get my slides here to work, there we go. So yeah, as Glenn mentioned, we're Asset Exchange Company. I'm the Eastern Regional Manager for the company, and we've actually been in business since 2006, and over the course of our existence, we've done about 40,000 1031 exchanges. All right. So it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, QI for short. Now, depending on the area of the country that you live in, you may hear other people refer to an accommodator. Another common term is a facilitator, or just simply an intermediary. But most often people just call it QIs. All right. And our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange, right? We hold those proceeds from that sale on behalf of the seller, the exchanger, all right? Because the rule is they can never have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange. All right, we're going to talk about that in some upcoming slides. And if anybody has any questions today, let's hold off into the very end of the presentation, because I find a lot of times if you do have a question, most often it's going to be answered in an upcoming slide. But again, at the very end, when we wrap it up, if you have questions, we'll open the floor up to questions. Now, let me give you all just a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that at least on a national level, a federal level, there actually is no federal agency that oversees what we do. So, what does that mean for everybody? Well, what that means is anybody out there can be a QI, right? There's no type of requirement you have to have any type of E&O insurance. There's no type of requirement you have to have any type of bond. There's no guidelines on where you hold the proceeds or the type of funds you hold the proceeds in. It's a really scary, scary thought when you think about it. So, if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right, I'll leave it at that. Great news when you deal with us, right? Well, we're actually based out of California. Our home office is in San Francisco. And because we're California based, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. All right, they do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in, which is great for anybody that deals with us in California, right? But anything that we do nationwide, all right, any exchanges that we perform in any state, that Franchise Tax Board has oversight in any file that we work on, all right? Because as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on. So you do have some assurances when you work with us. And then, as far as our ownership goes, we're actually owned by two gentlemen, one of which is actually a tax attorney. Now, his name is Adam Skarsgård. Adam's actually been in the business for like 20 plus years. He's considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on tax law and real estate, that type of thing. The whole reason I like to bring his name up is because, one of the things that we offer that I don't know if anybody in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited by the IRS, we would actually provide free audit support. All right, we'd work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney owner. All right, so enough of the commercials, right? So here we go. So let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around for close to 100 years. All right, it really started back in the 20s. And, back in those days, it was pretty simple the way exchanging worked. Maybe I had a farm that I grew corn, and I knew another farmer, he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm, so we just swapped farms. And that was really, it was really that simple back in those days. But our modern day exchange is kind of the format that we follow today. Well, that was started back in 1979. All right, there was a gentleman by the name of T.J. Starker. Now, Mr. Starker lived in California. He owned all this land in California with timber on it. All right, and what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is in exchange for the land, they gave him what was referred to as exchange credits, right? And what Mr. Starker did is over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with TJ Starker. All right, so if anybody on the line today has ever heard of the term a Starker exchange, right? That's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs that, I don't know, they may have been in the business for, I don't know, 40, 50 years, something like that. They still refer to a 1031 exchange as a Starker exchange, right? So again, you'll hear that term pop up every now and then, but that's where it comes from, T.J. Starker's last name. Now, when we talk about 1031, tax deferred exchange, right? That name is actually derived from Internal Revenue Code, Section 1031. All right, and the code states this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business. Now, I know that's kind of a mouthful, right? Well, the code states that you can use real property that you held for productive use in a trade or business, right? I'll give you guys an example of maybe the way that could work. We did an exchange for a gentleman. Now, he owned a daycare center, right? So he was using that real property for his business. So he sold it in a 1031 exchange. And then in his case, his replacement property that he purchased, well, he went out and bought another daycare center. Because why? Because he was going to use that real property for his business. All right. So any type of real property that you use in your trade or business, you can sell that in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business. All right. Now, the next part of the code where it states for investment. So for investment could be something as simple as, let's say you own a single family residential home and you hold that property for investment. Well, how do you hold it for investment? Well, it's a rental property, right? You can take that rental property, you can sell that in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, like kind property. So what exactly is like kind property? Well, like kind property is any type of real property that you use in your trade or business or that you hold for investment. You can sell it in a 1031 exchange, and you can replace it with any type of like kind property, which is any type of real property that you use in your trade or business or that you hold for investment. All right. So just because you're selling that single family home that you hold for investment, that rental property, when you sell that in a 1031 exchange, you don't have to replace it with another single family residential home. Now, you can if you want, by all means, okay? But you could even replace it with a condo, a townhome, a duplex, a fourplex, a vacant land. You could replace it with a commercial shopping center, a commercial warehouse, okay? Any type of real property. It doesn't matter if it's residential or commercial to residential. Everything is interchangeable. Okay, everything is interchangeable in the respect as you could sell property that you use in your trade or business, and you can buy replacement property, or vice versa. You could sell investment property and exchange it for property that you're going to use in your trade or business, right? And where can those properties be located? Well, they can be located anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right. Sometimes I get the question, people will ask me, they say, well, what about a property in Puerto Rico? Well, Puerto Rico is not included in that number. The reason being, I think, is because I think Puerto Rico is under a different tax structure than we are here in the States. And that's why property in Puerto Rico is excluded from 1031 exchange. All right, if anybody on the line today has ever heard of the term a like kind exchange, that's where it comes from. It comes from that part of the code that talks about like kind property. Now, here in Florida, where Glenn and I are located, there's a standard real estate contract that all realtors use in the state of Florida. It's referred to as the FAR bar. It was just revised. It just I think last month, maybe the month before last. In the real estate contracts that realtors use here in Florida, there's standard 1031 exchange language already built into the contract. Right? It's in Section 18 and it's item N. Right? In the contract, it refers to a 1031 exchange as a like kind exchange. All right. So again, if you ever see that term pop up, that's where it comes from. It comes from that part of the code that talks about like kind property. All right. Now, what are current tax rates? Well, typically when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains taxes. Now, capital gains tax right now is either 15% or 20%. All right. Now, the 15% was applied historically if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you're at the 15% capital gains tax rate. Now, the 20% capital gains tax rate historically was applied if you were single and you had income of greater than $400,000 a year, or if you were married and you had income greater than $450,000 a year. Now, the reason I say historic, right, is because the income levels have risen just a bit in the last tax reform bill that they passed a couple of years ago. But any way you look at it, you're still going to be subject to either a 15 or 20% capital gains tax rate. Now, on top of that, you would also be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, you may be asking yourself, well, how does that work, right? Well, depreciation recapture tax works like this. Any depreciation that you've claimed in the property for the lifetime that you've owned that property, all right, when you go to sell that property, they're going to hit you with a 25% tax, depreciation recapture tax, on the entire amount of depreciation that you've claimed for the lifetime that you've owned the property, all right? Now, on top of that, you may also be subject to what they refer to as the Medicare tax, all right? That's an additional 3.8% tax. Now, how does that work, right? Well, the Medicare tax, that was something that they passed back in 2010 with the Affordable Care Act, Obamacare. It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act. All right. The great news is when you do a 1031 exchange, you can defer having to pay any of these taxes. All right. Now what do I not have listed on the slide? Well, I don't have anything up there that's talking about state income taxes. All right. Well, for me and Glenn, we live in Florida. We don't have state income taxes, so we don't even need to worry about it. All right. But if you live in a state, or if you're selling property that is located in a state and you have state income taxes, you would also be subject to state income taxes. Now, the great news, again, when you do a 1031 exchange, you can also avoid having to pay those state income taxes. Right? Now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right, I'll give you guys a couple of examples, at least for exchanges that I was involved with. Now, we did an exchange for a gentleman. He was a Florida resident, all right, but he had property that he was selling, investment property that he was selling in California. Now, the good news for him was he was doing a 1031 exchange because California has state income taxes. I think their state income taxes can be as high as, like, I don't know, it's like 11 or 12%. It's something like they charge you. The more you make, the more they charge you. The higher your tax. Excuse me. So what they made him do to get out of having to pay those taxes, because he was doing a 1031 exchange, he had to complete this state of California form, and he had to submit it to the state. And that's how he got out of it. But it's my understanding he's got to submit that form every year thereafter. All right. The year he doesn't submit that form, they come after him for the taxes. All right. Now, we did another exchange for a lady. She was another Florida resident, but she was selling property. I think it was in Maryland. And Maryland has state income taxes. Now, good news for her, she was doing a 1031 exchange. So to get out of those taxes, she had to complete the state of Maryland form. I think we even had to sign off on it. And I think she had to submit it to the state. I think it was like 20 days prior to closing. And that's how she got out of having to pay those state income taxes. Again, every state kind of has their own way of completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right, so anybody on the line today, if you're a realtor or if you're an investor yourself, okay, think about it. If you're looking at having to pay all these state income taxes, or realtors, if that's your client and they're not thinking about 1031 exchange, okay, it's a perfect opportunity for you to bring it up to them, right? Because if they can save on the federal taxes, and also if they have any state taxes that they're going to be able to save on, it's just going to give them that much more buying power to go out there and buy a better property, right? If they no longer have to cut that check or those checks, right, it's going to give them that much more of an opportunity to go buy a better property. And for you as a realtor, if you're the one that recommends it to the client, right, you're going to look great to the client. And what are you going to do for your commissions? Well, now if they can go out and buy a higher dollar property because they have more funds, and hopefully it's going to be a higher income producing property for them as well, you're going to increase your commissions, all by recommending a 1031 exchange, right? So that's win-win all around, right? Client wins, realtor wins, everybody wins, all right? So some things to think about for everybody on the line today, right? Now, I get this question, I don't know, maybe every day. People will ask me, say, well, hey, Jeff, how long do I need to hold on to a property for it to be considered an investment property? And the honest answer is, I don't know, because there's nowhere in the code that states how long you need to own a property for it to be considered an investment property. It just states you need to use a property in your trade or business or hold it for investment. Now, if you ask some CPAs, they'll tell you, boy, a good rule of thumb is hold on to it for probably about a year, for 12 months. And if you just think about the logic behind that for a minute, let's say they buy their property in 2021, right? Now, they're going to hold on to it for at least a year. So they're going to claim that property on their 2021 taxes as an investment property, right? Any income that's coming in from rents, any expenses that are going out, right? They're going to claim that in the 2021 taxes, and they're holding on to it for a year, right? They're also going to claim it on their 2022 taxes as an investment property, right? Remember, any income that's coming in, any expenses going out. So over 2 tax filing years, they would actually be showing to the IRS that it is an investment property, right? Now, is that a good rule of thumb? Well, the answer is maybe, right? Some other CPAs will tell you, no, you really need to hold on to it for at least 2 years, right? And one of the reasonings behind that, we're going to talk about it in the very next slide, but back in 2008, the IRS came out with guidelines regarding vacation homes, okay? And in those guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must hold on to that property for at least 2 years or 24 months. All right, so some CPAs pick up on that, and they say, well, for vacation homes, the IRS is letting us know, hey, for that to be considered an investment property, you must own it for at least 2 years or 24 months. Therefore, any type of investment property, a good rule of thumb is to hold on to it for at least 2 years or 24 months, right? But the reality of the way the whole thing works is it's not so much about how long you own the property. It's more so about your intent, right? And your intent could be something like this. Did you advertise the property for rent? Did you advertise it for fair market value rent? If fair market value rent is, let's just say, $1,500 a month, and you're advertising it for $5,000 a month, you know what? The IRS is probably going to have an issue with that. All right. If you get audited and the IRS comes in and says, hey, prove to us you held that property for investment, you're going to have to be able to back it up. All right. I list one particular court case on the slide. It's referred to as Resnick versus the commissioner. All right. In that particular court case, the circumstances was you had a husband and wife, right? They owned a single family residential home. Now, that was their primary home. Okay. They also owned another single family residential home that was an investment property, a rental property. Okay. They sell the rental property in a 1031 exchange. The replacement property that they purchased was another single family residential home. That was going to be the new investment property. Now, during the 6-month period after they did their exchange, okay, they ran a classified ad in the town newspaper that they lived in, advertising that property for rent at fair market value. They even showed it to 2 potential renters during that period, but for whatever reason, they could never get the property rented out. Now, what else happened during that 6-month period is one of them loses their job. Okay, so they had a mortgage on their primary home They also had a mortgage on that investment property, but what? It wasn't rented out, right? So after 8 months of ownership, they wound up selling their primary and they moved into the investment property. In that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Well, the circumstances changed and they were forced to do something, right? So again, remember, it's not always about how long you own a property, it's more so about the intent. And as I mentioned, if you ever get audited, you're going to have to be able to back it up. All right. Now, let's talk a little bit about vacation homes. I always like to talk about vacation homes because, hey, I live in Florida. Glenn lives in Florida. Here in Florida, everybody wants a vacation home or everybody has a vacation home. So, how does that vacation home qualify as an investment property? All right. This is actually referred to as Revenue Procedure 2008-16. All right. And the first guideline I've already given you guys, you must own that property for a minimum of 2 years or 24 months. Okay. Now, for every 12-month period of ownership, okay, you must rent that property out for a minimum of 14 days at fair market value. Okay. Now, you can also use it for some personal use. Okay. For every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that it was rented during that 12-month period. Okay. So I'll give you guys an example of maybe the way that could work. Let's say during that 12-month period, you actually rented the property out for 200 days, right? So 10% of 200 would be what? Well, it would be 20, right? So you could use that property for 20 days personal use instead of the 14. If that property meets those guidelines, it qualifies as an investment property and you can use it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say that it would be disqualified. In that particular situation, I'd recommend to the client, I'd say, look, talk to your CPA. All right. If you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, hey, by all means, use it in a 1031 exchange. All right. We're always going to recommend to people talk to your CPA because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I would even ever want to know, right? Hey, if the CPA comes back and says, yeah, I think we can justify the property as being an investment property, then you know what? Move forward with it in a 1031 exchange. All right, so that's vacation homes. Now, let's talk a little bit about why exchanging is beneficial to realtors. We probably have some realtors on the line today. Well, for one thing, with exchanging, it's always going to be 2 transactions. All right, so 2 transactions. What does that mean for realtors? 2 commissions. All right, with exchanging, there's always going to be a property that's being sold. That's the relinquished property. And there's always going to be a property that's going to be purchased as a replacement property. So 2 transactions, 2 commissions. Now, one of the rules to 1031 exchange, the replacement property that gets purchased in a 1031 exchange, that purchase price must be either equal to or greater than whatever the sales price was on the property that was sold. So what does that mean for realtors? Well, what that means is the commission that you're going to make on the replacement property is going to be as good, if not better, than what it was on the property that was sold, the relinquished property, just because of that rule. All right. Now, the 1031 tax savings benefit, we've kind of already mentioned that. Remember, we were talking about what the current tax rates are. Remember, if the client is not talking about doing a 1031 exchange, you recommend it to a client. You help them save on all their taxes, either the federal and also possibly the state taxes. That's going to give them more buying power, the ability to go out there and buy a better property. Hopefully, it's a higher dollar property and a higher income producing property for the client. And what is that going to do for you as a realtor? You look great to the realtor, and hopefully you increase your commissions. I'll tell you what, sometimes we even see this. Sometimes the property that's being sold in a 1031 exchange, okay, the property that's being purchased, the property that's being purchased in a 1031 exchange, the seller of that property, sometimes they are also an investor, but guess what? They don't know anything about 1031 exchange. Again, you realtors, if you can mention it to them, you can bring it to their attention. Who knows, maybe you can pick up another transaction by helping them find some replacement property. All right, y'all think about this. Any property out there that is non-owner occupied is a potential 1031 exchange candidate. Now, why? because if they don't live in the property, they might be holding it as an investment. All right. There's databases that you guys can tap into to get those kind of leads. All right. Realtors tell me within the MLS system, there's a system product that's referred to as iMaps. There's also another product that's referred to as Remind. All right. Also, depending on the county, some property appraisers offices will let you do searches by absentee owners. All right. People tell me with Remind and also iMaps, you can do searches by absentee owners. Absentee owners, they don't live in the properties. They might be holding them as an investment. All right. If there's any realtors on the line here in Florida, all right, think about it. If you work any of the areas of Central Florida, any of the retirement areas of Florida, any of the coastal communities, the beaches, right? There's non-owner occupied properties, absentee owners in all of those communities. They're everywhere. Okay, if you've always thought, hey, I really would love to get my foot in the door with investors, but how do I do it? Maybe 1031 exchange becomes a tool for you to go out there and target those investors. And you already have those databases at your fingertips. You just need to tap into them, learn how to use them. All right. So some things to think about for everybody today, right? Now, we're going to talk about the property qualifications. We're going to talk about the tax deferral requirements. There's some timelines everyone needs to be aware of. And there's also some identification rules you need to be aware of. Let's recap. What type of property can you do a 1031 exchange on? Any type of real property, right, that you use in your trade or business or that you hold for investment. You can exchange it for what? Any type of Litecoin property, which is what? Any type of real property that you use in your trade or business or that you hold for investment, right? Where can those properties be located? Anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. Remember, property in Puerto Rico is not included in that number, all right? Now, what type of property is excluded from 1031 exchange? Well, your primary residence, okay? You cannot do a 1031 exchange in your primary home. For your primary, you may qualify for what they refer to as a Section 121, all right? And the guidelines for the 121 are you had to have lived in the property as your primary any 2 out of the last 5 years, okay? And if you have any gain when you go to sell your primary, you claim the 121. If you're single, the first 250,000 of any gain is tax exempt. And if you're married, the first 500,000 of any gain is tax exempt. All right. Now, you don't need anybody like me to help you with the 121. All right. That's just something that you claim on your tax return in the year that you sell your primary residence. Okay. Now, property held for sale is also excluded from 1031 exchange. All right. Now, I'll give you an example of maybe the way that could work. You know, here in Florida, we have a lot of these like national home builders, like Pulte Homes, Lennar Homes, KB Homes. Let's say I'm Pulte Homes. Now Pulte Homes, they're one of the largest single-family residential home builders in the entire country. They are a publicly traded company, all right? They build newly constructed properties in multiple states, all throughout the United States. Well, the properties that they build, all right, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because those properties are being held for sale and not for investment, they can't do 1031 exchanges on those types of properties, okay? So property held for sale is excluded from 1031 exchange. Now, dealer property is also excluded from 1031 exchange. Now, dealer property might be somebody that we most often refer to as a flipper. You know, they buy a property, I don't know, 2 or 3 months goes by. During that 2 or 3 month period, they fix the property up. And then what do they do with it when it's completed? They turn around and sell it as well, right? Well, they can't do 1031 exchanges on those types of properties because that's like their business. That's their inventory. They fix properties up, and then what do they do with them? They turn around and sell them. Well, you can't do 1031 exchanges on those types of properties. Now, you know, here's a possible solution that a flipper may be able to do. Let's say they buy a property. Again, I don't know, 2 or 3 months goes by, they fix it up. And when it's finished, okay, instead of turning around and trying to sell the property, they go to their realtor and they say, hey, can you put this in the MLS system showing it for rent? Now let's make sure we put it in there for fair market value rent as well. That's a little bit different, right? Because why? Because now all of a sudden, what are they doing? They're showing their intent that they're holding it for for investment and not for sale, right? Hey, who knows? Maybe they even show it to a potential renter, right? They run some type of credit check on that potential renter. I don't know. They don't have such great credit, and they decide not even to rent the property to that potential renter. If that flipper ever gets audited, and the IRS comes in and says, "Hey, prove to us you held that property for investment and not for sale," they're going to have to be able to back it up. All right. And the example I just gave you guys, hey, there's a good shot they would be able to back it up if they did that. They could say, look, here's an email that I sent to my realtor on such and such a day, requesting that they put it in the MLS system at fair market value rent. Hey, here's the day, here's the MLS listing showing it at fair market value rent. Here's the day I showed it to that potential renter. Here's the credit check I ran on that potential renter. All that type of stuff is going to be what? It's going to be their backup. It's going to be their proof that their intent was to hold it as an investment. But remember, if they buy a property and however long it takes for them to fix it up, and when that property is completed, if they turn around and sell that property, they can't do a 1031 exchange on it. All right. Now, foreign property is also excluded from 1031 exchange. Now, this might be pretty obvious to most people on the line, but let's say I couldn't sell a property, an investment property located here in Florida in a 1031 exchange, and then try to buy a replacement property, I don't know, somewhere in Canada or Mexico or Europe. Okay, it has to be what? It has to be property located in the United States or property in Guam, the U.S. Virgin Islands, or the Mariana Islands. Right. So foreign property is excluded from 1031 exchange. Okay. Now, the tax deferral requirements. In order to get a full deferral, okay, to defer your taxes 100%, all right, rule number one is you must reinvest all of the net proceeds in property of equal or greater value. So what does that exactly mean? What are the net proceeds? Well, that's the cash, all right? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, the QI. We're going to hold the proceeds from that sale on behalf of the seller, the exchanger, because the rule is they can never have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange. Okay, so they can't close today, call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late. All right, they couldn't even close today. Walk out of the office that they just did the closing, the title company, attorney's office, escrow company, okay? Get in their car in the parking lot and call me from the car and say they want to do a 1031 exchange. At that point, it's too late, all right? Because their funds may be sitting in that escrow account of the attorney or the escrow company or title company. They may be waiting to wire their funds out to them. At that point, they have what's referred to as constructive receipt. They have a legal right to the funds. They've lost their ability to do a 1031 exchange. Okay, so we have to get involved prior to the closing. All right, today at noon, I got a call. It was a client calling. She's also a realtor, but she's a seller of an investment property. It was closing at 1 o'clock today. She said, Jeff, I want to do a 1031 exchange. We pulled it off. We pulled everything together and got it over to the title company in 30 minutes. Okay, so again, you have to get me involved prior to closing. If you don't, you lose your ability to do a 1031 exchange. All right, so back to the rule. All right, we're going to hold the proceeds on behalf of the seller. Now, what do they need to do with those proceeds? They need to take that entire amount and they have to go out and buy a replacement property, or it can even be multiple properties if they want, all right, where the purchase price or the combined purchase prices, if it is multiple properties, is either equal to or greater than whatever the sales price was on the property that they sold, okay, the relinquished property. That's rule number one. Now, rule number two is if they have debt, you must acquire an equal amount or greater debt in the purchase of any replacement property or properties. Now, what's the debt, right? The debt, that's a mortgage, all right, a loan, okay? Whatever that payoff amount is, you're required to get a loan of at least that amount or greater in the purchase of any replacement property or properties. Now, that rule can actually have an exception, okay? If you have cash that you can add to the purchase of your replacement property, you can offset that rule. All right. Now, obviously, if you don't have a loan that you're paying off, well, you're not required to get a loan in the purchase of your replacement property, but you can obtain a loan if you need to or if you want to help you purchase your replacement property. Okay. Now, there's some timelines everyone needs to be aware of. Okay. So from when you sell your relinquished property, from the date of closing, from that point forward, you're going to have 180 calendar days to purchase any replacement property or properties. Now, that's calendar days, that's holidays, that's weekends, okay? Hey, Glenn and I, we live in Florida. Well, from June 1st to November 30th is what? Hurricane season, okay? If we're getting hit with a hurricane and everything's shutting down for a day or two or a week, whatever it may be, folks, it doesn't matter, all right? That clock is always, always, always going to be ticking, all right? So it's 180 calendar days to purchase your replacement property. Now, the first 45 days of the 180 days is referred to as the identification period, okay? Now, what exactly does that mean, right? Well, the identification period means this. You must identify any potential property or properties that you want to buy. Okay, now they don't have to be under contract. You just have to identify any potential properties that you want to buy. Now, that's something else that we're going to help with, right? We're going to provide to the client, the exchanger, a form. It's called the identification ID letter. And on that form, there's going to be some blank lines, right? And it's going to have to be specific to a property address or addresses. They're going to have to fill it out, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. Okay, they're going to do it to us, the qualified intermediary. Again, they don't have to be under contract. But here's the thing about the 45 days. Let's just say they find that perfect property, but it's day 46. At that point, it's going to be too late. All right, so whatever they put on that form by midnight of the 45th day, they're going to have to make sure they're going to be able to purchase at least one of those properties, and they have to purchase that one of those properties by when? Day 180. If they're buying the property on day 181, they're going to be paying all their taxes. All right. Let's just say, hey, they list 3 properties on the form by midnight of the 45th day. Right after midnight of the 45th day, one of them gets sold. One of them burns down to the ground. They only have the opportunity to purchase that one other property that they would have identified. There's no going back after midnight of the 45th day saying, hey, one of those properties that I listed, it just sold. There's no way I could ever possibly buy it. It doesn't matter. If you're unable to purchase any of those properties that you listed on that form, unfortunately, you're going to be paying all of your taxes. All right. So there is no negotiating. There is no extensions to in either one of these timelines. It's very specific. Okay. Now, there's some rules to identifying. All right. Now, there's 3 different rules. All right. Now, I'm going to read each one of the rules to you. And if you don't quite understand them, don't worry about it. I'm going to walk you through some really quick examples of how the numbers work. And hopefully, once I show you the numbers, it'll make sense to you. All right. Now, the most popular rule that we see investors enacting, probably, I don't know, 90 to 95% all the exchanges that we do fall into this first rule. It's referred to as the 3 property rule. Okay. And the 3 property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean? What's fair market value? That's the sales price. Okay. As long as you identify 3 properties or less, the purchase prices can be any dollar amount. It does not matter as long as you identify 3 properties or less. Now, if you say, well, I want to identify more than 3 properties, well, that's no problem. You can do that, but it's going to put you into this next rule. Okay, it's referred to as the 200% rule. And what that rule states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean? Well, what that means is if you identify more than 3 properties, the combined purchase prices of all those properties cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, all right, the relinquished property. Now, if you want to exceed the 3 property rule and you also want to exceed the 200% rule, you can do that as well. But it's going to put you into this next rule. Okay, it's referred to as the 95% rule. Now, it's very rare that we see investors even enacting this rule. Um, it doesn't make a lot of sense the way it's written, but remember, everybody, this is the IRS, and sometimes this stuff just does not make sense. Okay, because it reads like this: you can identify over 3 properties, you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, right? um, like I said, the wording, it doesn't make a lot of sense, but let me show you all the examples, especially with this last rule, and hopefully once I show you the examples, it's all going to make sense to you. All right, so here's the 3 property rule. Again, if you identify 3 properties or less, the purchase prices can be any dollar amount of any of those properties. So here's a quick example. All right, we sell our property for $1 million. Now, we go out and we identify 3 properties, all right, because we've identified 3. We're in the 3 property rule. Now, let's keep the math simple. Let's say, hey, we're going to buy each one of those properties for $1 million, right? So we've identified $3 million worth of property, right? Now, we could be buying each one of those properties for $10 million a piece for a total of $30 million in identification. Again, it doesn't matter as long as it's 3 properties or less. It doesn't matter. But what does matter, and I'll say it again, okay? If you identify 3 properties, boy, you better make sure you're going to be able to purchase at least one of those properties. So, what's the best way to lock up a property? Well, it's to put one of them under contract, and you're not required to put it under contract as far as identification goes for the rules, but in practice, especially in the market that we have going on right now, where it's a seller's market, the best way to lock up that property is to put one under contract. So that's typically what we see is somebody will identify one property that's under contract, and I don't know, maybe they'll identify 2 other properties just as backups, because again, if after midnight of the 45th day, if the property that they have under contract, that whole deal falls apart, at least they'd have the opportunity to purchase those 2 other properties. All right. Now, excuse me, here's the 200% rule. Okay, now this is when you exceed the 3 property rule, but then you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, we go out and we identify 5 properties. Okay, because we've identified 5, what just happened? We exceeded our 3 property rule, right? So that's going to put us into the 200% rule. So what exactly does that mean, right? What that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, gosh, where are they getting that $2 million from? Well, we sold it for $1 million, right? So 200% of that $1 million sales price, or 2 times that $1 million sales price, is how much? $2 million, right? So that's where I'm getting the $2 million from. Hopefully everybody gets this one. I think it's pretty straightforward. All right. Now, here's the 95% rule. Now, again, this is where you exceed the 3 property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. So here's how it works. Again, we sell for $1 million. Now, in this example, we go out there and we identify 10 properties. Okay, because we've identified 10, we've exceeded our 3 property rule, right? Now let's keep the math simple on this one. Let's say we're going to be buying each one of these properties for $1 million each. So how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened there? We exceeded our 200% rule, right? Because that was how much? $2 million. So that's going to put us into this 95% rule. So in our example, let's just say we're only able to purchase 9 out of the 10 properties. Well, that's only going to be 90%, right? Or $9 million. That's not 95%. If we do that, if we're only able to purchase 9 out of the 10 properties, guess what's going to happen? We're going to blow our entire exchange, and we're going to have to pay all of our taxes. All right. So the reality of the way the 95% rule works is it's really 100% of whatever you identify, you're going to have to buy. And we're using really simple numbers, right? We're saying, hey, each property is going to be an even $1 million. You know what? the purchase prices for those properties are going to be all over the map, right? It's going to be really hard to sit down and say, let's see if I buy this property. Wait, gosh, that's only going to put me at 93%. All right, maybe I need to make sure I purchase the other property. Wait, that's going to put me at 94%. Again, the 95% rule is really 100% of whatever you identify, you're going to have to buy. Okay. The IRS wants to limit you in how many properties you can identify. They don't want you going out there identifying everything under the sun, because you know what's going to happen if you identify everything under the sun? You're going to have to buy everything under the sun because of this crazy 95% rule. Again, it's really rare that we see it enacted, but just want everybody to make sure it does exist, and you just need to be careful. All right. Now, how does the whole closing process work with 1031 exchange? Well, we really don't start doing anything or getting the process started until there's a contract on the property that's being sold, right? Because the way the process gets started is I need to get a copy of that contract. I also need to get the contact information for whoever's going to be handling the closing. And I also need to get the contact information, obviously, for the client, the seller. But what happens once we get the contract and the contact information for the closing company, we're going to reach out to that company, and what we're going to get from them is a copy of the title commitment. Now, it's also known as a title search, or the commitment, or the binder. Just depends in different areas. The preliminary just depends on the different areas of the country that you live in. But basically, it's a search of the title. All right. Once we have that in hand, along with the contract, what happens on our end is we're going to prepare what we refer to as an exchange agreement. And those will be documents that will set the exchange up. We're going to email those over to whoever's going to be handling the closing. Okay, they're going to be waiting there for the closing to happen. Day of closing, seller's going to come in, they're going to sign those documents. When they sign those documents, that's basically going to give us the ability to step into their shoes as a seller. That's also going to give who's ever handling the closing the ability to take those proceeds from that sale, and they're going to wire those proceeds over, and we're going to hold them on their behalf. Okay, that transaction takes place, and then what happens? Then the clock's going to start ticking, right? 180 days to close. First 45 days is the identification period. We're going to be sending out that identification ID letter. Client's going to be filling out, signing off on it, getting it back to us by midnight of the 45th day, right? Now, once they do obtain a contract for the replacement property, we'll need to get a copy of that as well, right? We also are going to need to get the contact information for the company that's going to be handling that closing. Now, chances are it's going to be somebody different, a different company, not the same company that handled the sale, because think about it. We're going to be holding all the proceeds from this sale. We're going to need to get a contact person. We're going to need to get their wiring instructions. We're going to prepare some other documents that we're going to send to that company. Day of closing, buyer's going to come in. They're going to sign those documents. That's going to give us the ability to step into their shoes as the buyer, right? That's also going to give us the ability to take the proceeds that we've been holding from their sale, and we're going to wire those proceeds over to whoever's going to be handling the closing to help them purchase their replacement property. Right? That's it. That's the entire closing process. It's not that complicated of a process when it comes to the closing, right? Everything leading up to it is the complicated stuff. It's like this stuff that you see day in and day out in the real estate world, negotiating the contracts, having to identify replacement property by midnight of the 45th day. Do you need to get a loan? Do you need to add cash? All right, all that type of stuff is the more complicated part of the equation. But the closing process is probably the easier part. All right. Now, what do we charge for our services? Pretty simple. On a delayed exchange, that's everything we've talked about today. Okay. That's where you sell first. All right. You sell your relinquished property first, and you buy last. You buy your replacement property last. You're buying that property by when? Day 180, right? That's called a delayed exchange. Most common exchange we do, we charge a flat $12.50. We don't collect anything until it closes. All right. As I mentioned, we send the documents over, waiting for the closing to happen. If for some reason that closing never happens, if the contract falls apart, the buyer walks, the client seller decides, hey, I don't want to do a 1031 exchange at the very last minute. No problem. We don't charge any type of cancellation fees. We don't charge any type of setup fees. We don't charge any type of wiring fees. Okay. Those are y'all on the line that are realtors. We're like you guys, right? We don't earn our fee like you don't earn your commission until a deal closes. Neither do we. All right, and our fee covers the sale of one property. It actually covers the purchase of up to 3 replacement properties. Okay, that's it. There's no other hidden fees, no hidden costs. Now, there's a few other different types of exchanges. We don't have time to go into them today. I think we have 1 minute left, Glenn. Um,
We,
but yeah,
we've got more time if you've
okay.
got
Well,
time.
yeah, I have another class that I teach.
Got
You
it.
want to bring me back? We can do the advanced
Yep,
class.
yep,
But
yep.
there's another type of exchange. It's referred to as a reverse exchange. It works just the opposite of a delayed. Okay, it's when you buy your replacement property first, and you sell your relinquished property last. Okay, they can be significantly more complicated than a delayed exchange. Okay, those start off at about $6,500. All right. There's another type of exchange called the construction exchange. It's another term that people refer to it as an improvement exchange or a built to suit exchange. That's when you sell your relinquished property, you find a replacement property, but you want to do some improvements to it before you acquire it. Okay. Um, those can be extremely complicated. They start off at about $6,500. All right. That's it. There's my contact information up on the screen. If anybody has any questions, feel free. I think Glenn's going to be monitoring them. If we're
Yeah.
waiting for questions to come in, go ahead, Glenn. What do you have?
Yeah, actually, somebody texted me a question a little bit ago on they're looking at selling a commercial property and they're looking to buy, it sounds like a new build or new construction.
Sure, you can do that. Absolutely. But remember, you have to, that new construction has to be completed by day 180.
Hmm.
That's the tricky thing with new construction, especially here in Florida for sure, because builders in Florida, they don't want to commit to a closing date. All right, because why? Because well, one thing, the weather, hurricanes, material shortages,
Supply
labor
chain.
shortages. Okay, if they close today, all right, they have to, that new construction has to be completed by day 180. If it's not ready yet, they're going to fail their exchange. Okay, so what I recommend to people is, if definitely if it's a house that's already under construction, maybe like a spec home, all right, that the chances of that being completed in 6 months, roughly 180 days, is greater. It just depends. If it can be done, great. If it can't be, you may want to choose something else as your replacement property.
So the next question I have here, Jeff, is, when does it really make sense to actually do a 1031 tax exchange? If somebody owes money on a particular property, when does it really make sense? How can they really figure that out?
It just, what I tell people is like, look, um, if you, what are your you need to get with your CPA and find out what your taxes are. Now, sometimes people say, well, I don't really have a CPA. I use TurboTax or H&R Block. And I say, look, if you want to just kind of ballpark it, here's a good way to do it. You say, okay, what are you selling your property for? What do you buy it for? That difference, whatever that amount is, that dollar amount, on average now, okay, on average, about a third of that is going to go towards paying your tax, going towards paying taxes. So I usually just take that number, multiply it times 30%, and you'll get a number. Now, when is it worth somebody's while? I don't know. What's the breaking point? If you have to pay 5,000, 1,000, 10,000, 20,000, I don't know. That's probably an individual decision. For me, if I have to pay $5,000 in taxes, because if the thing is, if you don't do a 1031 exchange, whatever that tax bill is, you're going to have to allot for that. And then whatever's left over, well, that's what you're going to use to go out there and buy your replacement property. Hey, it's going to cost you $1,250 with us. Deduct that out. That's what you're saving, roughly. Okay.
So yeah, that's great insight. That's fabulous insight there, Jeff. I think that's wonderful. So look, what I know about Jeff is like the king of 1031 tax exchange. I mean, he is the guy. Everybody knows that I deliver great content on what's going on in the market. I've noticed that there's more 1031 tax exchanges coming aboard, not just this year, not just recently, but in the last couple of years, been more and more. And I think that's people's understanding and maybe adverseness to paying taxes.
Right.
It's a great tool that I think people should maximize. And Jeff knows the ins and outs. So I would invite everybody to obviously look at Jeff's contact information here. It's on the screen, 813-999-2524. You've got the email there. And Jeff's always been very helpful. And just like you said before, whether you're a realtor or most of the people that are watching this are going to be part of the public. If you have questions about that, and remember, this is for investment properties. We're not talking about single family or
Primary
primary,
primary homes.
right? So we're talking about investment property or anything, any other type of real estate outside of primary home is really what we're talking about here. And it sounds like it's very malleable how you can exchange too. So it doesn't have to be commercial for commercial necessarily, right?
Right, exactly right. Yep, everything's interchangeable. Mhm.
So Jeff, I want to thank you. Thank you very much. I know you've got to run.
Yep.
People are going to, let me tell you something. People are going to be watching this. This is going to be one of those evergreen pieces of content
All right, we're good.
for a
And
while.
I'll mention this too. Some of the topics that we talked about today, I have in just individual PDFs. If anybody wants that information, feel free, shoot me an email. I'll get those over to you. Especially if you're a realtor, you have clients that have 1031 exchange needs, you really love to have something email them to them. Hey, if you're an individual investor, you're not ready to do something now, hey, I'll send it over to you. If you want to talk, I want to be a resource for everybody on the line today. All right. I talk to people about 1031 exchange all day long. If you have clients or individually you have questions, let me know. Okay. All right, Glenn. Thanks again for bringing me in today.
Thank you, buddy. Appreciate it.
All right. Have a good one.